Welcome back to the Introvert Guy. In today's episode, I want to provide you with an in-depth update on the current status of the Chinese economy, with a specific focus on the Chinese stock exchange. If you've been following this channel, you're likely aware that 2023 has posed significant challenges for China. At the beginning of the year, there were high expectations for economic growth in China. In December 2022, all COVID-19 restrictions had been removed, and it was anticipated that the Chinese economy would achieve more than 6% growth. However, as you might know if you've been keeping up with our discussions, the last 6 months have proven to be quite trying for China. Exports and imports have declined significantly, and ongoing issues in the property sector continue to trouble the economy. In today's video, I aim to shed light on the current state of the Chinese stock markets. As the broader economy has slowed down, the value of Chinese companies listed both in mainland China and Hong Kong has also declined. This situation is causing major concerns, particularly due to the increasing popularity of a financial product known as snowball products. These snowball products are complex derivative financial instruments that originated in China in 2010. Initially, these derivatives were mainly available to institutional and fund investors, but as they began offering bond-like coupons to investors, they gained popularity. It's estimated that a significant stock market downturn in China could result in approximately $27 billion in losses for holders of snowball products. Many of these derivatives promise returns of 15% to 20% to investors, and they are structured similarly to option contracts, where investors bet on the future share prices of underlying companies. However, there's a crucial difference between snowball products and traditional options. Snowball products have two defined prices called the knock-in price and the knockout price. The knockout limit is the upper level of the share price, and if the share price rises above this trigger point, investors exit the contract and receive their payment. The risk for investors lies in the knock-in price, which is the lower limit set for share price movements. If the share price falls below this level, typically set at around 20% to 30% below the current share price, it crystallizes a loss for investors. In the event of falling share prices, these snowball products can result in substantial losses for investors. There are concerns that a significant stock market decline in China may trigger these losses and cause further turmoil. This situation has prompted the Chinese authorities to increase their level of involvement. They are considering direct investments in the stock exchange to prevent further declines. This intervention represents a form of market manipulation, which is not commonly observed in other countries around the world. In today's video, we'll delve into Chinese listed companies, the Chinese stock markets, and their size relative to other global markets. We'll also explore the risks associated with snowball products and the proposed levels of market manipulation by Chinese authorities. I will conclude the video with my analysis of what is likely to happen in the Chinese stock markets over the next 3 to 6 months and the potential ramifications for the global economy. Before we dive into the details, I want to express my gratitude to everyone who has supported the channel by buying me a coffee or sending YouTube super thanks. Your support is invaluable. And if you'd like to continue supporting the channel, please check out the links below, which provide access to additional content and ways to avoid ads on YouTube. The history of share trading and stockbroking in China dates back over 130 years. In 1891, the Shanghai Sharebrokers Association was established, along with the Association of Stockbrokers in Hong Kong in 1904. The Chinese stock market was officially named the Shanghai Stock Exchange in 1904 and remained China's largest market for the next 45 years. However, after the establishment of the People's Republic of China in 1949, the stock exchange was closed to foreign investment. It gradually reopened to the outside world in the late 1970s and 1980s. On December 19, 1990, the Shanghai Stock Exchange officially reopened its operations to the rest of the world, along with a second exchange for smaller and medium-sized enterprises in Shenzhen called the Shenzhen Stock Exchange. In September 2021, Beijing also launched a stock exchange covering smaller and medium-sized enterprises. In addition to the 3 exchanges based in mainland China, China also utilizes the Hong Kong Stock Exchange, founded in 1891. Unlike the Chinese stock exchanges, which have limitations on overseas investment, the Hong Kong Stock Exchange has been open to foreign investors throughout its history. Buying shares of publicly traded companies in the People's Republic of China is not as straightforward as in many other countries. Shares on most public markets worldwide are generally available to anyone with the financial means to purchase them. In contrast, the Chinese stock markets have strict restrictions on who can buy shares and what is available for purchase. Publicly traded companies in China typically fall under 3 share categories. Chinese A shares. These shares belong to incorporated companies based in mainland China and are listed on either the Shanghai or Shenzhen stock exchanges. Shares are issued in China under Chinese law and are quoted in Chinese yuan. They are generally available only to mainland Chinese citizens. While it's technically possible for overseas investors to invest in these companies, only a select group of qualified foreign institutional investors can do so. B shares. These are shares in Chinese companies quoted in foreign currencies, like the US dollar or the Hong Kong dollar. B shares are listed on Chinese stock markets and are freely available to foreign investors. H shares. H shares represent the shares of publicly incorporated Chinese companies listed on the Hong Kong Stock Exchange. These shares are issued in China under Chinese law and are quoted and traded in Hong Kong dollars. H shares are open to all overseas investors. This chart illustrates the 25 largest stock exchanges in the world by market capitalization. It ranks them based on the total market capitalization of all the companies listed on each exchange as of the end of August. As you can see, the New York Stock Exchange is the largest in the world, with a market capitalization of around $25 trillion. It is followed by the NASDAQ in the USA, with a market capitalization of approximately $22 trillion. The Shanghai Stock Exchange ranks as the 4th largest stock exchange globally, with a market capitalization of around $6.7 trillion. The Shenzhen Stock Exchange in China follows closely behind, ranking 6th with a market capitalization of approximately $4.5 trillion. The Hong Kong Stock Exchange comes in at 7th place with a market capitalization of about $4.2 trillion. The movement of these markets over the last 7 years has been remarkable, with the total market capitalization of these 25 exchanges growing from $69 trillion in 2016 to $110 trillion today. In terms of the global distribution, 47% of this market capitalization is based in the Americas, 29% in the Asia-Pacific region, and 24% in Europe, the Middle East, and Africa. Snowball products, also known as snowball structure income certificates, are a type of complex derivative financial instrument created in China in 2010. Initially, these derivatives were limited to institutional and fund investors. However, they gained popularity over the years, offering bond-like coupons to investors. In 2021, as the pandemic and a weak economy prompted brokerages and investors to seek innovative solutions, snowball products gained even more traction. Many of these derivatives offer returns of between 15% and 20% to investors. The structure of these deals is similar to option contracts, where investors place bets on the share prices of underlying companies. However, the key difference with snowball contracts compared to options is the presence of two defined prices: the knock-in price and the knockout price. The knockout limit is the upper level of the share price. If the underlying share price rises above this trigger point, investors are taken out of the contract and paid. The risk for investors is the knock-in price, which is the lower limit for the share price's movement. If the share price falls below this level, usually set at around 20% or 30% below the current share price, it triggers a loss for investors. This chart provides an illustration of how snowball products work. The scale on the left shows share prices in Chinese yuan, with the blue horizontal line representing a share price of 100 Chinese yuan. The dotted lines at the top and bottom show share prices of 103 and 75 yuan, respectively. The red line depicts the share price's movement over time. Under the terms of a snowball contract, investors receive a return of 20% over a 12-month period, as long as the share price remains within specific parameters. If the share price moves very little over the next year, the contract offers a satisfying return. The red dots on the chart represent the monthly testing periods, after which income would be released to the investor. If the share price falls outside the agreed parameters, it crystallizes a loss for investors. In the event of rising share prices, if the red line had remained within the parameters on the right side of the chart, crossing above the 103 level, it would represent the knockout value, terminating the contract. The investor would be paid for that month, but the contract would no longer continue. To provide a real-life example, let's say an investor invested in the China Securities 500 index with an initial price of 7,000 points and an investment amount of 1 million Chinese yuan. If the market fluctuated wildly and the CSI 500 index dropped to 3,500 points, this would trigger the knock-in effect and result in a 50% loss, which in this case would be 500,000 Chinese yuan. In August, it was announced that China's securities regulator had approved the launch of 37 retail funds as part of a government initiative to revive the stock market. These newly approved funds would inject capital into the Chinese markets through 10 ETFs that track the small cap CSI 2000 index, 7 tech-focused ETFs, and 20 innovative mutual funds that charge investors floating fees based on fund size performance or holding period. Despite these market support measures, the Chinese stock markets have continued to decline. Over the last 2 weeks, Chinese authorities have indicated their consideration of creating a state-backed stabilization fund to restore confidence in the equity markets. The plan calls for the fund to have access to total capital of hundreds of billions of yuan. This move follows the announcement that China's Big Four state banks, the controlling state parent shareholder Central Huijin Investments, have bought Shanghai-traded shares and plan to further increase their holdings over the next 6 months. Essentially, this represents a capital injection into these banks directly from the state. In essence, we are witnessing significant market intervention. This chart shows the movement of the CSI 300 index, which represents the largest 300 companies listed on the Chinese stock market over the last 5 years. The index rose from a low of 3,650 in March 2020, at the beginning of the COVID-19 pandemic, to a high of around 5,800 in February 2021. However, there has been a substantial decline in the value of the CSI 300 index since then, currently sitting at 3,560. This is lower than the level during the initial stages of the pandemic. To gain a more current perspective, let's focus on the past 12 months. Around this time last year, the index was trading at 3,500. By the start of February, it had risen to 4,200, driven by renewed optimism for the Chinese economy in 2023. The removal of COVID-19 restrictions and expectations of strong growth had investors hopeful. However, the stock market's fortunes reversed over the last 6 months due to challenges in the Chinese economy and the broader global economic slowdown. This downward trend in the index raises concerns because the stock market should ideally reflect the economic performance of China. A disconnect between the markets and the economy could have far-reaching implications. In conclusion, I've shared this video to provide you with insights into the ongoing developments in the Chinese stock markets. While most discussions have centered on the Chinese economy, such as exports, imports, and issues with property developers, the stock market's performance reflects the economic challenges faced by Chinese companies. The snowball products we discussed earlier pose unique risks, especially when the stock market experiences a downturn. As these products resemble bonds, it's easy for investors to underestimate the risks associated with underlying assets' share prices. Additionally, the Chinese authorities' increasing intervention in the stock market to stabilize share prices and prevent losses is an intriguing aspect to consider. In most other countries, when share prices fall, companies must take actions to improve their financial health and appeal to investors. In China, however, the government can step in and buy substantial portions of shares to boost demand and potentially raise share prices. It will be fascinating to see how the Chinese stock markets perform over the next 3 to 6 months, and whether the market remains closely tied to the country's economic fortunes. Whether the markets bounce back or show a disconnect from the economy will be an important development to watch. If you found this video informative and thought-provoking, please show your support by giving it a thumbs up. Thank you for watching this video in its entirety. And here's something to put a smile on your face.